Inflation in the U.S. is now at the highest level since 1982, with headline CPI coming in at 7% as of today's data release. Steve Hanke, professor of applied economics at Johns Hopkins University, is an expert on monetary theory and inflation, and he is here to discuss with us exactly what happened and what will happen to prices going forward. Professor Hanke, welcome back to the show.
Good to be with you, David, and a Happy New Year to you.
Good to be with you, and Happy New Year to you as well. Now, you have called for this, Professor Hanke. You have called for 6 to 9% inflation by the end of 2021. So your forecast has been accurate. The question on everybody's mind now is this the peak?
No, it's not the peak. Just to get the record straight here, on January 20th, John Greenwood, who was the chief economist at Invesco in London, and I wrote an article in the Wall Street Journal, and we did predict that inflation would start surging from July when we wrote that article until the end of the year, and it would end up in something of 6% or maybe as high as 9%. It's 7%. So we ended up being right on the money. And the question is, well, why? I mean, what did we do? Did we have a crystal ball? No, we had no crystal ball. We had the quantity theory of money. MV equals PY. It's the money supply, stupid. If you have a surge in the money supply, you're going to eventually, after a lag of 12 to 24 months, get inflation into the system. So since COVID started, David, in March of 2020, the money supply measured by M2 in the United States is grown by over 38%. Now, some of that growth accommodates growth in the real economy. So a little bit is drained away for that. A little bit is drained away because there's an increase in the demand for money as the economy is growing. But out of that 38% plus 38% growth, about 75% of that is left as a residual. Now that is going to go into the economy as inflation. And that, as I say, starts after a period of about 12 to 24 months. And so we're just getting the start of this is flowing through into the system. And I can give you, if you bear with me just a second, some interesting price statistics. We have the overall inflation. We know it's going up. It will stay with us, by the way, in that 6 to 9% range going into 2024, because that residual, that 75% of the 38 trillion that's been in the increase is going to seep out of the system and keep inflating things. It's excess money. But if you look at the breakdown of the prices in the economy, and you split it into 5 groups. You have 99 prices for 99 different kinds of commodities or services, goods, and so forth. And you break it down into 5 groups. So if we look at March of 2021, that's a year after the COVID started, we had the following breakdown. We had 3 price groups that were below 5%, negative. They were deflating, actually. We had 18 out of the 99 that were in the -5 to 0% inflation. We had 24 that were in the 0 to 2%, and we had 36 that were in the 2 to 5%, and only 18 above 5%. Now that's completely changed. You've got a big shift as this excess money comes into the system. We not only have overall prices going up, but look, we have nothing is in the -5% range. Nothing is in the -5 to 0% range. The 0 to 2% growth in prices, only 9. And then we get into the 2 to 5% growth. We have 42 out of the 99, and the over 5% range, we've got over 48. So what this is showing is this breakdown. We started in March of 2021, and we have kind of an even distribution of prices. Some going down, some static, some going up a little bit, some going up a little bit more. Now everything has shifted out of the deflationary static group and into big increases. Almost everything is increasing with prices at over 2%.
Yes.
And in fact, about half of them are actually increasing over 5%. So this is the quantity theory of money in action. You produce excess money, and eventually, with a lag of 12 months to 24 months, bang, it starts coming out, that excess in inflation.
Okay.
And we see that in the overall price index, and you see it with this distribution of prices that I've given you.
Well, it has been more than 12 months since the start of the pandemic when the Fed first announced unlimited quantitative easing. But let me ask you this, Professor. You have stated this many times. In fact, so many that I've memorized this quote. This is a quote from Milton Friedman, of course, and he said that inflation is always and everywhere a monetary phenomenon. So given that, according to monetarists, inflation is driven by monetary policy, not supply chain disruptions, can we then assume that inflation might wane due to Fed tightening? Remember now, Professor, that the Fed has indicated 3 rate hikes this year. Some speculate potentially even more may happen in 2022, and they've already started their asset purchase tapering program. So do you think that 2022 will be the year of lower money supply and hence finally lower inflation?
Well, number one, the Fed's doing a lot of talking, but they're not doing any tightening. The money supply measured by M2 is still growing at over 12% on a year-over-year basis. And to actually hit their inflation target at 2% per year, they would have to bring that growth rate down to about 5 to 6%. That's about half of what it actually is right now. So you must keep your eye. It is all about the money supply. It is not yakking about interest rate increases and things like that. You only look at the money supply. And the money supply right now is growing about double the rate that would be consistent with a 2% inflation target.
So are you saying then that even if they do raise interest rates, I'm not saying they will, but suppose they do raise by 75 basis points, even 1%, that in itself may not be enough to reduce the money supply. It won't bring, in other words, a higher interest rate, a higher Fed funds rate may not necessarily bring down the M2 money supply.
That's correct.
Okay.
And the problem with what we're facing now is that the excess that they've already produced, that's there now, we know it's there, and they're still producing an excess, by the way, this 12% versus a golden growth rate of around 6%. They're still pumping things up. That's going to be with us for a while. This is going to be persistent because remember, the lag between money injection and inflation, 12 to 24 months, as you indicated, that's correct. So even now they're producing money at too fast a rate, and that will be with us, right what they're doing today will be with us for another year or two. Just what they're doing today, let alone the massive excess that's already been accumulated due to the post-COVID surge in the money supply. By the way, the one thing that we did talk a little bit about interest rates. There is one possibility that it is a scenario. I'm not saying it's going to happen, but it might happen, and that is this inflation has gone up now, and it could spook the Fed so much and frighten them so much that they start increasing interest rates too rapidly and panic. They've done this before. They could panic because they really don't know what they're doing. And if they panicked and raised interest rates too rapidly and too high, we could easily have a recession. And then we would have the old stagflation problem. We'd have a recession and we would still have the inflation.
Okay, so all right, so recessions can still happen with M2 being at record levels?
Yes.
Okay.
Yes,
And
that could happen. They've done it a million times before. If they panic once they see these higher inflation numbers are persisting and won't go away, and if they panic and overreact and increase interest rates too rapidly and put them too high, we could dump ourselves into a recession. That is a possibility. I'm not predicting that's going to happen. That's what we have to keep our eye on, David.
Okay. So, Professor, given that it may not be enough to simply raise interest rates, what can the Fed do to combat this inflation, if at all they're interested in bringing the inflation down to lower levels?
They can combat it and have an effect by 2024 by just lowering the money supply growth. It's all about the money supply growth. No one is talking about the money supply. And the reason they're not talking about it is that the politicians, the political class, number one, doesn't really understand much about this. And the Fed also, even though it's a central bank, they don't understand much about it either. And as a result, they want us talking about a lot of ad hoc, irrelevant causes for inflation because the politicians don't want to get nailed by being the bad guys and causing inflation, because no one likes inflation. And certainly the Fed doesn't want to get nailed as being the bad guy. So what do? They spin a yarn, and the yarn is inflation is a transitory thing. It's caused by all these oddball things, supply chain problems, port plug-ups, the weather, meat prices going up because the supply of cattle is unusually low. Monopoly, they've even come up, the latest thing in the United States, they want to engage the Department of Justice in raising Cain about antitrust violations, that the monopolists are causing inflation. No, inflation is always and everywhere caused by a money supply, and the Fed is responsible for the money supply. But they don't want us talking about that. So that's the propaganda. It's pure propaganda, everything you're reading in the press. And the press, of course, goes right along with it. It's amazing. The press, you don't read about the money supply, by the way. You read about all these ad hoc excuses for inflation because the press basically has bought into everything they're fed out of Washington, D.C., and namely Chairman Powell, who's the chairman of the Federal Reserve. Because what did he say in February? Well, we've gone through this before, David. You tipped me off on this. February testimony.
I remember that.
Chairman Paul, and he's back and forth with Senator Kennedy from Louisiana, said, forget money. It doesn't have any influence over anything. And he said, we have to relearn economics. He basically said, we have to deep sex the quantity theory of money and forget about it because it doesn't have anything to do with what's going on in the real world.
You should invite Fed Chair Jerome Powell to be a guest lecturer at one of your lectures. I'd like to see your students' response.
I just love to do that. That's a great idea.
Second tip of the year. I'm starting each year off with a tip for Professor Hanke. I got two more questions and I'll let you go. The first one being, look, you've stated that inflation has not peaked. How high could it go from here?
Right now, if nothing changes and the money supply keeps growing at its current rate, or even if it goes down to 6%, even if it goes down to 6%, let's assume, because John Greenwood and our calculations assume that they would become rational and lower the growth in the money supply measured by M2 to 6%. Assuming they do that, we will have something north of 6% inflation going into 2024. That excess money it's already there. Well, so it will come out into inflation.
That was my question. How long this persistence actually is? Are we talking about perpetuity? Are we talking about a few years? Because let's suppose, I'll give you a hypothetical example.
No, we're not talking about perpetuity. We don't know, number one, we don't know what the Fed is going to do. Let's just do the arithmetic the following simple way. Let's assume they reduce the growth rate in M2 from its current over 12% year over year to something like 6%, which would be consistent with a 2% inflation target. Let's assume they do that right away. Then, under that scenario, we will have inflation over 6% and persistent through 2022, 2023, and into 2024.
Okay. Well, let's just suppose in theory, I'm making a theoretical example now. In theory, if the money supply, if M2 money supply does not change from current levels, it stays elevated forever, could it not mean that in theory, inflation would stay at current levels forever?
Well, yes, that's exactly what would happen.
So you're saying eventually the money supply will have to come down?
Pardon me?
You're saying eventually the money supply will come down?
Well, I'm saying that the probabilities of it coming down are probably higher than staying at the current level. And the reason for that is that the current rate of inflation is 7%, which is a record of sorts for us, is unacceptable. The public is not going to accept this. And as a result, the Fed will eventually sober up and take the punch bowl away from the table and stop drinking that Kool-Aid, whatever is in it, and lower the growth rate in the money supply. That's the most likely thing, because this thing, President Biden can't keep spinning this yarn that, it's the beef prices going up. That's why we have inflation. It's used car prices going up. That's why we have inflation. Sooner or later, the public is so annoyed with this already that sooner or later they're going to have to pivot into a slower growth rate in the money supply.
All right. Well, Professor Hanke,
that's what I think the most likely thing is. I hope they don't panic into this and increase these interest rates too rapidly, though, because then we will not only get the inflation that's already baked in the cake, we'll get a recession.
All right, Steve, thank you so much for your insights and for your explanation of what happened with CPI in the last month. Now, before we go, I have to plug our new series. You and I are doing a Kitco educational series. It's never been done anywhere. And this is going to be exceptional in the sense that we are bringing financial literacy to the audience. We'll be discussing key macroeconomic concepts, and we'll be discussing them to varying degrees of difficulty, from all the way from beginner to the advanced level. So I'm looking forward to doing that with you.
And one thing we'll talk about is the Hanke Coffness Gold Sentiment Index, by the way. Which,
yes,
by the way, the sentiment has gone from mildly negative to rather positive in the gold market, and of course the price of gold has gone up in the last few days, as you've noticed.
Yes, of course. All right, well, thank you again, and thank you for watching Kitco News. Don't forget to subscribe to our YouTube channel. I'm David Lin.